All right, so we're getting near the end of the course here, but I do have a few other gems that may help you in your studies, and these are just things you should backtest and note. There's a lot of things I always note that are outside of actually inversions, and just you're gonna see what I'm talking about. All right, these are the things I put emphasis on, and I mention a lot of these in my stream. So 80% of the time, I'm using equal highs, equal lows, or highs inside of a low, or highs inside of a fair value gap, or low inside of a fair value gap, and then LR, right? That's what I'm using a lot of the time. Like, I'm not going to search for a random liquidity pool. These are like the main things I use. So I basically just wait till they come, and then obviously data highs and data lows. The other 20% of the time, which is not very much, I use London high, London low, previous day high, previous day low. Um, Out of these, I would say I rank these number one, high day and low day. So just the highs and lows we make between 9:30 and like whatever. So if we create a high at 9:30, I'll use that for liquidity. If we create a low at after 9:30, I'll use that as liquidity. Okay, like when I'm looking at price throughout the day, like I'm always using high and low of days liquidity. So like again, we create a high hit day here. Okay, we create another high day of here. How are we displacing through it? Are we displacing through with a lot of displacement? All right. Here is a lot different. We don't really displace through these as much as we displace through this one. So I don't really trust the retracement, or I don't trust an inversion setup after we obviously break stuff like this, because just like how I talked in my example before about like, okay, would it make sense from a common sense point of view? Like here, for example, okay, we break this range with so much displacement. We break the high day with so much displacement, meaning I would trust the long more. But we break this high day with just not a lot of displacement. So it just makes me not trust this inversion fair value gap long. All right. So you can see I'm using these highs and lows days and just kind of seeing, okay, are we displacing over them? And if we aren't, that probably means we're not gonna accelerate up as much. Okay, so like if you think there's a higher time frame bias that you're missing, you need to see us displace well over the higher day or low day. And here we did. So there's probably something to the left if I had to guess that we hit. But you can see we're slowing down. We're barely displacing over at this time. So I just wouldn't trust any inversion setup long here. Okay. So that's important to note. Equal highs and equal lows on ES are not as important to me as they are on NQ. And this is actually because, so you have to be careful using them in ES. I will say this, okay? So if I go to ES, all right, and I'm looking for equal highs and equal lows, they need to be like, there needs to be a lot of them. So, and they need to be really far away. So this one, you got 3 equal lows here, and you got 2 more here, and the fact that these are just really far away, the momentum's going towards them, it makes sense to use these. But there's going to be a lot of equal lows and equal highs in ES that we don't take. Like for here, for example, okay, that's 4 equal highs. I think we do take them later, which is interesting. But look what happens later. We make more equal highs later, and you can see price just doesn't hit them. Okay, so we're gonna make a lot of equal highs and equal lows that we're not gonna take. Okay, and that just it happens a ton on ES. And I think they're much better in NQ. So the way I teach equal highs and equal lows do not apply in ES. The bad ones you're not gonna want to be like, okay, price has to go here. Are the ones that they're like there's only 2 of them and they're really close together. So like these ones. Okay, they have to be somewhat like a bunch of candles apart. Okay, so like these two I wouldn't mind using for like later reference because these are very far apart. Okay, if I go to like the 5 minute, and I look for equal lows and equal highs in the 5 minute. See, so none of these are equal highs. So these ones right here, these are farther apart. Okay, these are farther apart. There's actually 3 of them, and we had momentum and order flows going up to them. So I figured these ones would be hit. All right, so you can clearly see like they should be farther apart in ES. You don't want to use the ones in ES that are like right next to each other, because they're just not as much. They're just not as heavy weighted. Like even these ones, these are right next to each other. So I know they're hit the next day, but they're still not. They still don't hold that much weight at that time. Versus NQ is likely not going to leave equal highs like this at the time they're made. Okay, but ES will do that a lot. So make sure you understand that you don't need to use equal highs and equal lows as much. You don't have to put as much weight on them as you do on ES that you do on NQ. Okay. So my favorite time to trade is 9:30 to 11. I know the kill zone is 8:30 to 11, but 9:30 to 11 a.m. is definitely my sweet spot. It's definitely when I have my highest win rate. I've lost I've lost pre-market trades at 8:30 to 9:30 a lot. The only time I will trade 8:30 to 9:30 is if we get some sort of data. So like today was a perfect example. We got NFP. So if I go to NQ chart, which by the way, you can either be on NQ1 exclamation point or NQH 2024. I just tend to go on NQ1. It doesn't matter really. If you are an NQ1, I turn on BAdge down here. So yeah, I think BAdge is good to have on. It's good to turn off in the right scenario. Like again, if you turn it off, it was good to turn off like the other week because we had momentum going to here. But like right now, it's good to have on because you can see we were rejecting a fair value gap. So this is gonna mean a lot more. This is gonna be a lot more obviously. So again, when I go to the 5-minute chart here, okay, you can see earlier we had our data lows right here, and you can see I actually did enter a trade like around 9 o'clock because look, if we have data, that's going to inject volatility into market. So I think it's fine as long as this news or whatever it is, usually it has to be red folder, it has to be major, usually it's NFP or like CPI. I find trading those NFP days or NFP data before the market open is like really the only time I'll take trades before the open because we still have a lot of volatility. So you can see right here today, like we got a nice CISD here, nice OB entry. Okay, and then we clearly it lines up with the bullish value gap. So this is a fine entry, and then we have data highs above. Okay, so I mean that's fine. Just understand if we don't have data on these days, price is not as super volatile before 9:30. So sometimes it's much worse, and inversions will get disrespected and respected again. So just be careful of that. All right. So 80. So again, make sure you remember the liquidity pools I use. I'm really mainly looking for these. The other thing is, I already went over this, but if AM session is good, PM usually sucks 80% of the time. So stay out. Okay. And by AM session is good, I mean, is there a big move AM session? If there is, it's and you're green on the day, just don't touch PM. It's hit or miss. And then if AM session is really choppy and there's a lot of seek and destroy AM, PM usually tends to be much better. And even lunch tends to be better. Like I typically don't trade lunch, but if AM's bad, lunch can definitely be pretty good. And I'm not going to show you this in the charts. You're going to have to backtest this yourself. But this is a general rule of thumb that I do. Okay. Another one, do not use equal highs or equal lows as a market structure shift. And I mean perfect equal highs and equal lows. Okay. So again, a lot of times we get equal highs or equal lows. People use them as a market structure shift when it's just a liquidity sweep. I personally do not think you should be using these as a market structure shift. Okay. So what do I mean? For an example, okay. Let's say this wick went down here, okay? So let's say this wick went down right down here, and these are perfect equal lows. They have to be perfect, keep in mind. If we break these perfect equal lows, I never use them as a market structure shift. It has to be a single low we break that's not an equal low. And this is more of a personal thing. I've seen these market structure shifts fail so many times. Just yeah, be very careful. You should not be using equal lows and equal highs as a market structure shit. They're not as good, okay? And you're gonna get screwed if you don't know the bias, okay? I'm not gonna be able to find any lifetime examples. I know there's an example like a few weeks ago that it looked like a market structure shift, but it really wasn't. So like this is your closest example you're probably gonna get right here. So we have equal lows right here. Okay, they're kind of relative equal. And price clearly breaks them, and this is where people are gonna be like, oh, this is a market structure shift, I'm gonna short here or whatever, and we end up going back to the high and then we dump. So make sure whenever we break structure, make sure they're not equal lows or equal highs. If it's to the upside, it's too risky taking those because you need to know that's a market structure shift. You need to not, like, sometimes these will, like, a lot of times with equal highs and equal lows, it will be just a liquidity sweep. Okay, you need to know it's a market structure shift. So just don't use equal highs and equal lows as a market structure shift. All right. So 10 to 10-10ish is a great time for reversal set if we get the framework. And the reason why is because this is when the 4-hour candle closes, or this is when the new 4-hour candle opens. So a lot of times, not a lot of times, but when the framework is right, we'll get a really nice reversal setup when the new 4-hour candle opens. So 10 o'clock is definitely a key time to watch a reversal, as well as 11 o'clock. So 11 o'clock is another time that's actually London close. So 10 is like the major time I'll usually watch for some sort of reversal, but 11 is also decent too. So it's around those times. So around when the 4-hour candle closes, for 10 o'clock. We don't get 10 o'clock reversals every day, and that's fine. But just know if we get a reversal around 10 o'clock, it's probably, and you get the framework for it, and it's the A+ framework that I've taught you guys. Just know that it's probably going to be a pretty high probability. Okay, because 10 o'clock, like I said, is a great reversal time. Like you can see here, this was a day where we swept liquidity here at 10 o'clock, exactly in the dot, and 10 o'clock ended up being the high for the whole day. So it's just a really good reversal time. It can add a really nice confluence to your trades, and yeah, you're gonna want to be interested in using that time to time. All right, so another thing, do not form a bias at 4 p.m. Wait till you wake up the next morning, and it's really easy for me because this one second. It's really easy for me because when I wake up in the morning, like I'm not trading at I'm not trading. I'm just waiting for 9 o'clock every day. I don't even like to but unless we have news, I don't like to check the charts overnight because I'm making a bias that could be false by the morning because we're gonna get so many more. We're gonna get like, think of this: you go to bed, you get off the charts at 4. By the next morning, from 6 p.m. to 6 a.m., okay, we're gonna get 12 more hourly candles because that's 12 hours apart. Like, why would you form a bias if you're gonna be missing 12 4-hour candles? It's like trying to form a bias and you'd have no candles, okay? You should be waiting for the overnight to play out, and then when you wake up in the morning, that's when you form your bias, not overnight. And there's times where you can anticipate a bias for the next day, but sometimes it hits during London, and that's gonna totally change things. So again, the nice thing is when we're delivering from a fair value gap, if I wake up at 8 o'clock and we have yet to hit an external lower high, that's my bias until the low is taken out. So like I'll go to bed sometimes and I'll wake up in the morning and I'll be like, oh, London session reacted off of an hourly fair value gap. Or I wake up and I see, oh, London session put in a order block or whatever it may be. And I know the bias is bearish now because we put in that order block, London dumped, and now like my bias is bearish as long as this order block holds until like the next intermediate term low. Okay, great example right here. I remember I woke up this morning and I saw, okay, London dumped, right? When I went to bed, look, when I got off the charts the previous day, you can see we got an hourly inverse. But this doesn't matter because this was at 4 o'clock and it's not during a kill zone. All right. And then you can see all these candles come out. And then I wake up, I get in the charts the next morning and I see, okay, I'm waking up. We're at an OB. We have momentum going down towards an intermediate term low here, which is kind of relative equal, not the greatest, but I guess you could call them relative equal lows. And we got momentum going down there. And that's going to be my bias for the day, all because of what I saw during London. So you're not going to know that the day before. And it's really nice to wake up and just not look at the chart overnight and then see what happened during London and then base your trade off of, okay, does London have momentum going towards a certain area? Or were we just chopping? If we were chopping, you could maybe use London high and London low for your liquidity levels. But it's a really good idea not to check the charts overnight. I remember I used to wake up in the middle of the night all the time and check the charts, and it wouldn't matter because stuff would change by the next morning. So know what delivering from means. I've talked about this in a lot of my YouTube videos, but delivering from a fair value gap versus delivering from the middle of nowhere. Okay, you need to understand what this means. Okay, I put so much more weight, like when we're delivering from a fair value gap or whatever it may be, like if I see price rejects a fair value gap and we clearly are getting bearish momentum down, like if I understand, okay, price is coming from a fair value gap, I know it's coming from an internal range liquidity, which means what? Which means we should go to the external range, and this all connects the market maker model. So just understanding where we're delivering from, whether it be an hourly fair value gap, whether it be a fair value gap at all, or whether it just be the middle of nowhere. Okay, so in this example, we don't really reject the fair value gap. I mean, we do reject the order block, but when I say delivery from, I'm looking for delivery off a Fair Value Gap and only Fair Value Gap. Obviously, we don't reject the Fair Value Gap here. We actually break it and then come down. So I make sure, like, if you know we're delivering from hourly, you're going to be much more confident biased rather than, okay, if we're delivering from the middle of nowhere, because half the time we deliver from the middle of nowhere, we don't really go back to the next low. So even right here, I understand we hit buy side here, which people are going to be like, oh, that's bearish, but we're probably not delivering from anything in the left. Okay. So that does not mean price has to reverse yet. But then if you see price is finally delivering from an hourly Fair Value Gap, now you know price is bullish, right? Now you know we're probably not going to go back to buy side, versus here we're not really delivering from anywhere. We just kind of reject it in the middle of wherever, and price does end up bouncing again. So just understand what delivering from means. It's very important when it comes to trading and how I trade. So remember that. Inversions require a body close above, not just wicking above below. So I still get questions about this, but make sure if you're using an inversion, it has to close above. Just because we wick above an inversion here, just because we wick above a bearish Fair Value Gap does not mean that's a close. That's does not mean that's bullish. This is still bearish because the body is still respecting this inversion, okay, or this Fair Value Gap, I mean. I always say this. I always say, if you take this trade and lose, would you regret it? Okay, I'm pretty sure if you know, like if you have a trade and you think it's textbook, I'm pretty sure you wouldn't regret it. There's trades where it's just I see, and just from a common sense point of view, it's not clean. It maybe looks like it works, but it's just not clean. And I'll take it and I'll lose, and I just be like, dude, why did I take that setup? It just wasn't clean. So if you think that about a trade, and you know, okay, if I take this trade and it's a loss and you would regret it, then don't take it. Okay. If you would regret it, it's likely either a revenge trade, it's not really the model and you're bending the rules a little bit, or it's just a bad time to trade. I've seen a lot of textbook trades at Asia, but I would still totally regret taking a loss during Asia. So that just means I don't take trades during Asia because I would regret it. So I always ask people that. It kind of helps a little bit, and it's going to really teach you to stay a little more patient. The other thing is, once you've traded long enough, like there's going to be like a buzzer siren that goes off in your head. And if there's not, if it's just kind of, if it does not pop right out to you, then don't take the trade. It means it's probably not a good trade. And again, the more screen time you play or you get, and the more times you play your model, you're going to see signature and price repeat. And if it's not a signature you've seen, there's probably no siren or buzzer going off in your head telling you to take the trade, right? It's because it's probably not something you've seen before. Like, you don't know if it's going to work. So you need that siren or buzzer going off in your head, knowing that the trade's probably going to work, which again, is going to come from screen time and seeing the trade setup play out a bunch of times. Okay. If there's no news for the day, you can still trade. Okay. But make sure, like, if it's a Monday with no news, make sure we're getting decent displacement at open. So obviously today we have news, so it doesn't count. But if I see we have no news today and I see the opening, I need to see displacement or some sort of, I need to see a bunch of Fair Value Gaps created in like the first 15 minutes. So like here would be one in the 1 minute, here would be another one in the 1 minute, and then here would be another one. All right, we get 3 Fair Value Gaps, so it's pretty good sign the price is going to be good. But if it's a Monday with no news and we don't get any Fair Value Gaps, that's generally a sign that the rest of the morning session is going to be bad, and typically the afternoon session is better. So I know people say don't trade no news days, which is fine, but I will still trade them if I see decent displacement off open. Some of my best days have been no news days. So, and the reason why people wait for news days to trade is because they say it's more volatile and better price action, because your news is manipulation. I know it sounds like, oh, news days would be more or be worse to trade, but usually that's not the case for the experienced traders. So again, if there's zero Fair Value Gaps formed and no displacement above old highs and lows on a day with row for further news, you probably should not trade. And that's typically within like the first 15, 20 minutes, okay? And this is, again, going to be something that you're going to have to backtest and you're going to start to notice. Bodies tell the story, wicks do the damage. This is an ICT quote. Okay, wicks, you should not care about wicks as much as you do to bodies, and this is going to come from screen time again. You're going to pay attention to the bodies. They tell you so much more, whether like a body is respecting a Fair Value Gap super tightly and not closing under. Like that's a very key signature and price to recognize. So just understand bodies are very important in ICT. If you do not know where price is delivering from, you probably don't know where price has to go. This is a quote by me. It goes back to the delivery thing. Like if I don't understand price is delivering off of a fair value gap right here, or whatever it may be, this is probably a 5-minute fair value gap. Okay, well then how do I know where price has to go, right? I don't, right? I need to know where we're delivering from for me to understand where price wants to go. It's very key, okay? So other useful charts, this you can go in the notes and save. I can't show you guys the full thing. Down here you're gonna miss some words. But this is kind of my chart for my inversion psychology chart, right? It's, do you understand the inversion model? Have you had success with it previously? Have you watched all 10 videos in my strategy? So this would actually be changed to, have you watched this course? Or you could watch my YouTube. It doesn't matter. Obviously, my YouTube is free. And then, do you know when to enter, stop out, move stop to break in, when to scale? Okay, you should be knowing how to do all these things. And if the answer is yes, okay, it goes to, is this the proper framework? The answer is yes. Good. Take the setup, right? You know where the stop and take profit is. And it's just kind of a little sheet to kind of talk you through if it's a good setup, okay? And this was made by someone named Amy, my Discord. She's awesome. So shout out to her for making this. All right. And then this is very crappy design made by me. This is obviously much better, as you can see. So your assignment for this video is going to be based off of some of these. So your assignment is going to be find 5 10 o'clock reversals. So I want you to find 5 10 o'clock reversals and show, like, write down the setup in your journal and annotate how you would have entered. Okay, so 5 10 o'clock reversals. Okay, and typically it's going to be around 10 o'clock to 10:10ish. Okay, those are the times you're looking at. So that's it for this video, and see you in the next one.